Hello all, welcome to Sand Compounding. This is Sandeep Anand. I'm starting a new series called 20 for 2030. And what does that even mean? For investors in investing, the formula of compounding, which is very powerful, and the formula is P into 1 plus R by 100 whole to the power N. And N is an exponential factor. N is nothing but, we all know, it's a time invested, time we invest in the capital is invested in a business, or the tenure as we can call. And the tenure or longevity of our investment is very important because if we make investments in businesses that can sustain for 10 to 12 years with a good level of growth and at the right valuation, we are made home. The returns on the capital invested would be very high. Now, how do we find businesses which can run and which has such longevity of 10-12 years, especially in today's world of disruption? Every business is getting disrupted. Erstwhile, no wonder Warren Buffett, the legendary investor, used to find businesses which are least disruptive and that can run for a long time with growth, and he called it as moat. While moat investing, I don't know if it's really that relevant in today's generation because all businesses are getting disrupted with the advent of digital and mobile and internet. Now, identifying such businesses is a very difficult task, and I have tried my best to find out 20 such businesses which can pay way till 2030, and come 2030, in hindsight, these businesses would have been great to hold for such a longevity period. Now, how do we find these businesses? I've applied the principle of inversion, which I learned from Charlie Munger, and we look forward to 2030, and when we look back in hindsight, the inversion principle, based on that, what businesses could and why those businesses could sustain till that period is what I've done. So here are such 20 stocks, and one most important thing, not in investing, not all businesses are great investments at all point of time, but most point of time. So there could be reasons being valuation is one important factor which can control the time when we enter into a business. If there are frothy valuations, our returns would be mediocre. So it's very important to identify great longevity, great businesses which has longevity and at the same time that has good growth and the right valuation. So, but this could be a blueprint or a watch list that we can use to identify, and when the correction happens or recession happens, these great businesses could be a great entry point, could give a great entry point. Hope this gets interesting as we move on. Continuing my series of 20 for 2030, 20 businesses for 2030. The next in the list is a business which is disrupting the whole media space. Gone are the days where advertisers would sit one-on-one with the publishers and acquire a retail space for putting the advertisement. That used to happen with print media and also to a great extent the cable TV and specific channels. Now that paradigm has shifted to a new paradigm where the advertisers are going to target advertising through a stream of channels, a multitude of devices, and it's going to be real time targeting customers instead of a public broadcast of marketing message. Now in this new paradigm, this is something called as programmatic advertising. Programmatic advertising has gained pace in terms of growth and spread after a series of launch of new streaming methods and new streaming apps by the internet giants. Started all with the Netflix, and it moved to Amazon, Spotify, for the audio part with YouTube and Hulu. There are a huge number of streaming channels now. Disney, all are part of the box or the TV that we have at home. This is called nothing but the smart TV, or the terminology used in the market is called connected TV. Connected TVs are going to be the future, whether it is for the media, the way we consume the content and the way people consume content has changed drastically, whether it is the devices they use, whether it is a live streaming they do, whether it is content on demand, on offline way they consume the content, everything has changed, and rightly so. To meet up that, the advertising also has to change in accordance, and the advertising that has changed, the methodology is called programmatic advertising. Now, what is programmatic advertising? It's very similar to the way the stock exchange trades stocks, and very similar to that, the advertising is done online real time through auction. The retail space, the real estate space to advertise is acquired by the advertiser through electronic programs, and these are automated programs, and the advertiser has access to all the devices, has access to all the channels across all the formats, and this is achieved by some players who act in between. They don't own anything, they are kind of aggregators of the space, the advertising space. They call it the platform, DSP platform, and the leader in that space is a company called TradeDesk. TradeDesk might not seem to be might not sound like a symbiotic to the technology disruptor, but trust me, they have gone and become the leader in the ad aggregation space. TradeDesk acts intermediate, and they intermediate between the publishers as well as the advertisers. Now the advertisers gets to choose where they want to advertise, which format they want to do, which devices they want to stream that into, and that's a big benefit for the advertisers. It's a big ROI increase for the bang for the buck, as to put it. Now this paradigm is going to sustain and grow even more, and that is evident from the way the connected TV has grown over the last few years in more than 100%, and even the programmatic advertising and the digital advertising is growing at a scorching pace, roughly 90-100%. If this kind of growth momentum sustains, the leader is going to benefit a lot. There are other players here, but I think TradeDesk, with its innovative CEO Jeff Green, as he puts it, they want to disrupt, and they anticipate, the IDC, which is a leader in anticipating and studying the market in advertising space. They predict this advertising, digital advertising or the programmatic advertising space to be around $1 trillion market value, and so the opportunity is huge and immense, and TradeDesk might be a great way to sustain the business for the next 1 decade. Let's analyze more in deep to understand what they do, how they operate, and why TradeDesk is part of the 20 for 2030 list. Now look at the caption of this slide. That's the messaging for the next decade for this company called TradeDesk. It's not a very known name. It's a digital play on that's advertisement supported streaming, and connected TV led by programmatic advertising. So if the next decade is all about the disruption in the TV and media space, and if it's all about programmatic advertising through the social sites, then TradeDesk is the play. TradeDesk is a technology that provides a platform for advertisers or ad buyers to reach targeted customers across omni-channel streams. That's like multiple channels and devices. Omni-channel would mean like TV, mobile phones, websites, phones, and everything, social and all that. Now founded by the pioneers of real-time bidding, TradeDesk has become the fastest growing demand side platform, they call it DSP, in the industry by offering agencies, aggregators, and the advertisers best-in-class technology to manage, display, social, mobile, and video advertising campaigns. Now they are purely focused on the buy side of advertising. So if you search for the competition for these guys, they know that most of the players are on the sell side for the advertising, and their platform is called SSP, whereas the demand side DSP platform which they have is a purely buy side of advertising, where the agencies and the advertising brands directly buy through TradeDesk, their platform. Now Jeff Green, who's a founder, current CEO of TradeDesk, TradeDesk also was the winner of the Wires by Exchange Wires and Digiday Media Awards. Both are different awards. The Wires is one, and Digiday Media Awards of Europe is another award. They won both for the best marketing technology solution 2019 and 2018. And their key winning propositions in the marketing are what they call as the next wave products, touted to be delivering immense value and ROI for the ad buyers. Now with respect to the competitive advantages and the business strategic positioning, TradeDesk method of focusing only on buy side, partnering directly with ad agencies to support their bid to the brand creates a strong strategic relationship with all agencies. Now that's a very good proposition. The USP is to maintain good relationship with all ad agencies, and as we all know, in the advertising arena, ad agencies and agents play a big role in driving value to the end customer or the brands. Now that has worked beautifully for their DSP platform, the relationship which I meant. They were strategically fostering the relationship, and that has helped them, create that retention from the agency standpoint. TradeDesk has high margins due to the high retain rate. What I mean by retain rate is from the bid spent on their platform, the advertising bid that is spent on their platform. They have a high retention rate of their takeaway. Basically, it's called the amount they are retaining. And since advertisers see high value, high measurable results, they are also giving a lot of data driven products on top of their platform. So overall, the advertisers are seeing high ROI and they don't mind spending. So that's why they have around 18-19% of the total bid spent on their platform gets retained by these guys, and that is a high margin that I'm talking about. The third positioning is MSA based ongoing relationship with brands and agencies that help in bring in repeat business over long term and sets visible business model for TradeDesk. So the customer retention rate is something that is highlighted here. It's at 95% repeat customers, and that is aided by or underpinned by the MSA, that is a master service agreements that they have over long term, and these agreements helps to have a binding over their relationship. Now TradeDesk was the first mover and in the programmatic advertising field, which is the future of advertising, and that has helped TradeDesk to establish partnership with all the rising tech giants in the media industry. So today, as against the NBCs and the Foxes and Star of the world, the media industry is getting disrupted, and especially with led by Netflix. Today all the tech giants are in the media industries, like Amazon, Disney, now recently launching the streaming services, Hulu. Even on the audio space, on the audible space, they have all audio for the music related things like Spotify, Pandora, and obviously they have partnership with the social media giants like Facebook, Baidu, Tencent, Alibaba and Google also. So they have relationship across the spectrum and across the markets, both US and China. They recently ventured into China, that we'll talk about in the next slide. With respect to revenues, profitability and operational aspects, the firm reported a net Q3 revenue recently in 2019 with a growth rate of 38% over Q3 2018. They recently did IPO, and the company is expected to generate $658 million in FY 2019. That's an estimated growth of 38%. Now in 2019, 50% of their revenue came from mobile channels, which is a significant thing to note, and that includes mobile videos. Now TradeDesk has been profitable since 2013. Every quarter they have grown up, and they are expected to generate operational profits of more than $170 million in 2019. Now they are operational. We can see the operational margins, right? I mean, that's around 29%, which is pretty high, and they are increasing investments across the operating expense lines at the same time, but they're maintaining a very stealthy operating margin. They have a high return on equity of 22-23% in spite of being in growth phase, while other competitors are seeing pressure on their margins, and especially the competitors when I talk about, that's the other advertising platforms which are losing money and they are losing the market share. Now TradeDesk, they are investing all the capital in the right places, like the next wave products. So What is good about this platform is, in addition to the retention amount, that's 18% margin they're maintaining, the takeaway from the bid spent on the platform, they are also providing, augmenting that with AI and data driven product suites and services on top of that, which is helping the customers. For example, KOA they call it. KOA is the next wave product that has reduced the average CPM clearance by 20% for marketers using the tool according to Ad Exchanger website. So the Ad Exchanger website has clearly indicated and highlighted the AI investments that's working out for TradeDesk. This is because Koa tool predicts publishers' floor pricing and auction mechanics. And in the field of marketing, the ad buyers only care about the ROI that enhance their campaign than the cost part of it. Now they are investing globally, especially heavily in Chinese market, to benefit from the programmatic wave and the digital wave in the next decade. Now they have a good cash position, around $297 million, no debt. That's something pretty strange for a high growth company in their growth stage, and operating cash flow of $136 million. So free cash flow is $100 million, a market cap of $11 billion. So it's almost like a small firm, a small capitalized firm in US market, and the growth potential is immense ahead. Price to earnings is not something I can really talk about for a growth company. The best part is they are at least positive in terms of profits. They are profit making, even if growing in the initial stages of growth. They are investing heavily, so the earnings is yet to show, and also the earnings will only increase if they can sustain this revenue growth. Now the operating leverage will kick in, because what we have to consider here, it's a platform and it's a technology platform, and with more and more agencies and end brands coming in, they are going to be margin accretive. Their return on equity is going to increase. At the same time, their profitability is going to increase, because operating leverage will kick in. Their investments will only be so much beyond a point, inflection point, then the fixed price per customer will increase, and the returns can increase significantly, and shareholders can benefit over if they hold longer period, because of the operating leverage that's kicking in. Now coming to the last slide, why I think TradeDesk will still be a great business to hold in hindsight when we look back in 2030. The first key point to be noted is the shift to the on-demand media and consumption of media by the customers has completely shifted to a new paradigm. And also in the TV space, the way we watch TV and the cable TV is gone, and the connected TVs, that will be the future. Plus, media world is moving more towards ad supported streaming channels, like more and more TV channels are discovering the new space which is supported by advertising revenue, and as against the old model of media, and even the later model of Netflix, where it was subscription based. Now there are many new streaming channels that's supported by advertising alone that's come up, like Quibi. Even NBC Universal has launched Peacock platform, which is ad supported. Then there is a Tubi platform, Tubi or Tubi. This platform again has a lot of users, millions of users, but that's supported by the advertising revenue. Now growth will be underpinned by the mobile and digital decade of 2020, driven by many transformational technologies like 5G wave, internet, and tech giants, monopolies. We can see the tech giants across America and China and Europe and even other emerging nations. The leaders are consolidating, and the technology giants are investing, getting into pretty much every possible business now. You could see all the tech giants getting into the media space as well, and that can disrupt the whole media space. And ad-led streaming channels, connected TVs, subscription services like Netflix, Disney, and audio services like Audible and Spotify, they're all changing the way we consume media and consume content. They also carry external competitive risk from tech giants, as we spoke about, because these tech giants can themselves create the platforms to gain benefits from the advertising. Now Roku is one classic example for that, and Roku, we have seen how the share has gone up in the last couple of years, and the earnings are growing so fast, and they have disrupted the model. Now, although because with all that, TradeDesk is still complementing their ad stream sources, because TradeDesk is not competing with any of them directly. They are kind of aiding to their, or acting as a streaming to their as a streaming source to their advertising revenue, and so which is beneficial for TradeDesk. Now, Magna Global estimates the programmatic advertising market is growing at around 20% this year, and overall advertising industry is growing at 4% according to IDC. So in the fastest growing segment of an industry that is expected to reach a total addressable market, they call TAM, of $1 trillion in the next decade. Currently it's around $750 billion, and TradeDesk is a leader, growing in the double the pace of the industry. It's around 40% growth. Now they are growing global, and China is their next biggest growth area. That's very important, and that's why I'm very sanguine about their prospects in the next decade. They are already partnered with Blue Media, the largest Chinese media agency, through which they have partnership with the biggies, Baidu, Alibaba, iQIYI, Tencent and all. Now, TradeDesk continues to invest heavily to stay at the forefront of innovation in the ad industry. They have seen major success with products such as cross-device, data and identity solution, and expects to continue that trend with new products to be launched ahead. So they just scratch the surface, I would say, in the programmatic advertising space and the digital advertising space. Now, connected TV will be the future, as we saw earlier, of advertising according to the market survey, and TradeDesk has the premium inventory supply from Amazon, Disney and YouTube of the world. Their major investment spend area is connected TV, with focus especially on live TV and sporting events. So more and more live sporting events, the ad space that the real estate they procure to show the ad with live sporting events and live streaming of gaming events, that is very high ROI segment, and it's a high margin for TradeDesk. The major after multiple years of triple and even quadruple digit growth in CTV, that's connected TV, Q3 year on year growth of connected TV was 145%, and that's precisely why their spend is also very high in connected TV. So the capital investment is going majorly towards connected TV, and like connected TV, audio is also a large growing format, about $3 billion according to PwC Digital Radio estimates. That's their fastest growing channel, and rightly so. They have invested heavily in the audio infra and inventory like Spotify partnerships. So overall, these factors are indicating that TradeDesk is going to sustain their business till 2030 unless something drastically come and disrupt their model. I hope this was useful.